Welcome to Capital Conversations, where innovation meets opportunity. Join hosts Karen Rands and Erik Nelson as they unpack the realities of raising capital, from angel investing to IPOs, and reveal what it takes for companies and investors to thrive in today's changing markets. Let's get started.
All right. Hey, welcome back, Erik. Good to be back live with you, sharing this great information. Today, for those that are listening, we all listened last week. We said we were going to do a highlight of the IPOs, because the big part of wealth creating is finding the way to create liquidity in your investments or as an entrepreneur, so that you can share in the benefits, the rewards of all the hard work that you've put into that company, as well as your investors that trusted you along the way. So real quick today, we're going to cover what is an IPO, what is an initial public offering, what are the alternatives to an IPO, like direct listing, reverse mergers, Reg A plus, as a way to sort of, the back door into, some people call it, into the public markets. We're going to talk about SPAC transactions. What is a SPAC? It's not a spit, it's a SPAC. What about cross-border listings? And we have time, we may get into a hot topic, because next week is all where hopefully you're going to be submitting questions to us, things you've seen in the news you want us to talk about, and we'll cover those. But there was an announcement effective of July 1 with OTCID basic market changing, so that the pink current market will cease to exist. So that's a big deal for a lot of people. And Erik is the guy that is best equipped to really address these for us. So, how are you doing today, Erik?
Hey, doing real well. It's good to be back in front of our viewers and our listeners, and I'm excited about today's conversation and taking a look at the overall overview of what is an initial public offering for companies that want to go ahead and raise capital, why they should be doing it, and what the alternatives are, and what the pluses and minuses of all the different alternatives are.
Okay,
And I think
great. So, one of the comments when we were first coming up with this outline and talk about IPOs, because we thought it was like one of the hottest topics to grab people's attention, you said it's not 1985 anymore. So what does that mean?
So the reason I say that is, as I work and do what I do during the day, through the transfer agency and the consulting side, there's a lot of people that I speak with that think that there are just hundreds upon hundreds of investment banks out there to raise money, like there was back in the 1980s and the early 90s, when there were penny stock firms all over the place, where the Blinder Robinsons, the Stuart James, firms that were still in business back when I started in the late 80s, were raising money in $2 to $5 million IPOs for companies on the over-the-counter market, and that they would also take in inventory, that they would find a company they liked and buy up the stock for their own inventory and their own investment account. And the IPO market doesn't work that way anymore, and it hasn't worked that way for a very long time, but there's still a misconception on that. And the IPO market had kind of, for small companies, had kind of locked up for a while, until about 5-6 years ago, when there was a few regulatory changes that spurred kind of a rebirth of initial public offerings for small companies. And I want to take a look at that, because there are opportunities out there to do IPOs a lot more than ever before, or in the last 20 years. And companies looking to raise capital should really be trying to take advantage of this. It's a good opportunity for them that's currently available. And as we all know, the number of IPO transactions kind of rises and falls with the economy.
Yeah, so let's talk about that, because I think there is part of a misperception that IPOs are all about liquidity, but as you mentioned, it's a way for companies to raise capital as well. So why do companies IPO?
Well, companies go public for a variety of reasons. Your larger companies may be going public, you know, primarily to provide liquidity for existing investors to increase their valuation. I mean, typically, a privately held company will trade at about 8 times its earnings, and a publicly held company will trade 16 to 25 times its earnings. So there is a unlocking of stored value. Well, when you're in the small and the micro cap market, companies are going public because they need money, because they've raised money and their investors want the liquidity, or they're looking to raise more money. So what we see is, it's the companies that need to raise 5, 10, 15, 25, 50, $100 million that are looking to go public nowadays. And there's a lot that goes into that process, being prepared for an IPO and being able to present yourself to these investment bankers and find the one that's the right fit for your company.
So does that mean that, like working through an investment banker, that they first raise capital for the company and increase the share base, and then complete the filings for those people to be able to go to be able to liquidate? They can buy it at a small, it's increased value, but it's still something that's still private that they benefit from with some type of uptick or like that?
Well, what happens is, dependent, and it all depends upon the circumstances surrounding the company and how well prepared the company is. In an ideal world, a company may be looking to raise some money privately and then do a follow-on initial public offering. And typically in those circumstances, and it depends upon the skills and qualifications of the investment bank involved, they may come in and do a private placement, raise some money for the company, and then do a follow-on offering at a higher valuation. Typically in such a scenario, the private placement investors may get some liquidity, may be registered in the initial public offering, or they may be locked up for a period of 90 to 180 days following that offering. In other circumstances, the company that the investment bank may not raise money prior to the IPO, and that's something that's the responsibility of the company itself. And then they're doing an IPO where the insiders are locked up for 6 to 12 months following the IPO. And that's what you see is much more common. And you see the $15 to $25 million IPOs in those price ranges.
So when you say, so are the insiders always locked up when there's a public offering?
Almost always, at least a good 90 days, even if it's a secondary offering.
So, okay, so let's talk about secondary offerings a little bit, because I know there's organizations like Advance Equity or Micro Ventures that offer access to, they're getting ready to go public, and employees sell stock before they go public to other private investors. Are you familiar? So can you talk about that a little bit, about
Yeah,
how
we can.
liquidity for those folks so they don't get locked up for 90 days to a year?
Yeah, so in situations like that, you're working with a secondary market where they're private transactions. And typically that would be employees and shareholders who are in need of liquidity or want to cash out sooner rather than later. They will engage one of those marketplaces to help negotiate a private transaction. And those are all non-public transactions. Now, the pricing of that will get reported and help set valuations for future transactions, but those are not the same as the IPO, obviously, or what is considered a secondary offering. A lot of times, in the more traditional sense, a secondary offering is a public offering of securities underwritten by an investment bank for an already existing company, a company that's already publicly traded. So, for example, if your company is trading on the over-the-counter market, and you're going to do an offering through an investment bank that's a registered offering that will uplist you to a stock exchange like NASDAQ or the NYSE Venture Exchange, that is the sort of offering that would be considered a secondary offering. Or if you're already on NASDAQ and you're going to raise some additional capital, that is considered to be a secondary offering. And there's a they have a lot of different characteristics that involve, with respects to the risk of the offering and the expected price performance afterwards that really separate them from IPOs.
Okay, so so how it so you talk about secondary offerings. Are they on an exchange the same way that an IPO is, or how are they different from an actual IPO then?
In an actual IPO, as your company has, become prepared, filed a registration statement that has been declared effective by the SEC, it then will go out and make an application to, say, the NASDAQ exchange. And it goes through the review and approval process with NASDAQ. And following NASDAQ's approval, the investment bank will begin marketing the offering, the IPO, to its clients, and based upon indications of interest, they will go ahead and they will set the price of the IPO, get the capital commitments, and then the next day they will begin trading the securities. And the pricing calls are typically done after the close of the day before trading is initiated. Where that differs from the secondaries we're talking about, if your company is already listed on NASDAQ and you do a secondary offering of your common shares, there is no exchange approval needed for that secondary offering because you're trading the exact same shares that are already approved. Now, if your company is on the over-the-counter market and you're uplisting to an exchange, you have to go through the application and approval process just like you're doing your initial public offering. And that's the primary difference between the two secondary offerings.
So one of the things that a question came up to me the other day when I was talking about Reg A Plus as a way to raise private capital and then complete the paperwork to be publicly traded on NASDAQ, I said it gives an opportunity. One of the values is that existing shareholders can exit at whatever that strike price is for the private offering, which will be different than what the public offering price would be. And they were like, where does that happen? So these are all just private transactions handled by investment bankers and broker dealers, or how does that happen? I mean, it seems like a secondary offering, and I'd heard way back when, of exchanges that were primarily for that, but it doesn't sound like there's actually any exchanges where there's a platform or a marketplace to be able to sell your shares as a private offering when somebody's getting ready to do a public offering.
Yeah, I mean, when you're seeing those, for example, SpaceX comes to mind. That SpaceX is a privately held corporation. It has raised tens of billions of dollars over the years, and it has rewarded its employees with stock and stock options. While I'm probably not personally familiar with the secondary market for those shares, they're either going to be occurring through a broker dealer that handles both sides of the transaction. So the broker dealer is matching the buyers and sellers of the securities. So they kind of maintain like their own internal bulletin board of where somebody's willing to sell and where somebody's willing to buy, and they try and find some equilibrium and try and match that up. And that's kind of the old-fashioned way of doing it. And what you might see in a little bit more sophisticated or more broadly held corporations is they might be using an alternative trading system, and these ATSs, as they're called, are kind of like miniature light exchanges. They're not fully functioning stock exchanges, but they're more sophisticated than just a broker dealer doing it internally, and they do have the ability to quote some public prices. But
Okay.
that is how those transactions get matched up. What I think is important is when we're looking at IPOs nowadays for companies is that there are a lot of investment banks that are actively looking for well-managed companies that they can raise capital for. So if you're an entrepreneur and you want to grow your business, these are avenues you may not realize for growth that were not, available. And now they are available and you can take advantage of them.
But didn't investment bankers and broker-dealers always raise private capital for companies, or is that a new thing that they're doing in addition to the exit strategy of an IPO?
So investment banks, engage in different areas of business based upon the qualifications of their personnel and their licensing approval from FINRA. So not all investment banks actually engage in the initial public offering process. So it really is a situation where some investment banks do strictly mergers and acquisitions. A lot of investment banks, particularly those here in Atlanta, are engaged in finding private equity buyers for privately held corporations. So the recent regulatory changes have basically spurred a lot of investment banks that were active in private placements to enter the IPO space. And so if you've got a company and you're looking to grow and you don't want to sell out and you want to continue to grow the business, raising money through an IPO is now a very attractive part of that process. And the number of investment banks that are engaging in, capital raising through the IPO process is growing. And that's an important thing for entrepreneurs and business owners to be aware of, is that this is an opportunity to accelerate their growth of their businesses and really enhance the wealth creation that owning a company can bring to the entrepreneur.
Okay. Well, I'm sure when we dive deeper in a couple of weeks, we'll get further into alternative trading systems and the secondary offerings. But let's move on to, what is a direct listing?
All right, so this is an alternative to going public from an initial public offering. And a direct listing is when a company basically fills out the paperwork and applies to list its own shares on a stock exchange or the over-the-counter market. And so, for example, you may have a company and you say, well, I would like to get publicly listed so my existing investors can have liquidity, or that I can use my stock as a currency for acquisitions, but I haven't been able to find an investment bank, or I'm not interested in raising capital. So what we see is a lot of small companies go public through the direct listing route, bless you, through the direct listing route on the over-the-counter market. And there was rule changes several years ago that have made this a potential for companies on major stock exchanges. One of the ones that comes to mind quite easily is Spotify. I believe went public through a direct listing. Spotify wasn't looking to raise capital at the time. It had plenty of money, so it applied for a direct listing directly on the NASDAQ national market system, and was able to list its shares up on NASDAQ without using an investment bank for an IPO.
Okay, so that sort of goes back to that part of the reason to do an IPO is to, in fact, raise capital, consecutively to, or, as a precursor to actually creating liquidity. So most companies, when they go public, it's part of that investment bankers raising capital for them, that those investors are going to get locked up for a period of time. Is that right?
Yeah, when you do an IPO, your prior investors do typically get locked up. In the case of Spotify, they could have got almost any investment bank they wanted to do an IPO. Now, I don't remember if there's valuation issues where they were felt they got a higher value by listing directly, or if they just felt like they did not want to get the dilution from to their own holdings from an additional capital raise. But I do remember that Spotify initially started trading at a pretty high valuation based upon the demand from retail and institutional investors that were not currently shareholders. So it's an option, but it's not used very often anymore by really big companies, because they do prefer the additional capital that comes with an IPO. One of the other alternatives to a direct listing is a reverse merger where a privately held company merges with a already publicly listed company, and that is a quite common method for going public.
So we'll go. Yeah, we'll get. Okay, we can, because we can come back in a couple of weeks and get further into direct listings, as far as like where are they traded and how do you go about doing that, and why are they popular. But so when it comes to reverse mergers, one of the things that I had is, so maybe this is the strengths and weaknesses or pros and cons or best practices to talk about, is that most of the companies I've seen do that because they're small and for some reason they want to get onto the public exchange, but then they're flat because they don't have market awareness, and they don't have, the bump of going public because the company's already public, usually thinly traded. And so
Yep.
now you have to go into a roadshow to try to sell it to broker dealers to promote to their clients. And it seems like it's always harder for reverse merger to get momentum in getting trading trading volume so they can attract pipe money.
That is true. Vast majority of reverse mergers, a large number of them occur on the over-the-counter market, where it's very difficult to get investor interest or trading volume to pick up on companies. Sometimes these companies end up having a following online, or attract the attention of somebody who is a pretty good online influencer, or hire the right IR firm, investor relations firm, and trading volume picks up. There's a large number of reverse mergers that are occurring on the NASDAQ and NYSE venture market. These are companies that typically would like to go back private, and so they're seeking to merge in a privately held company into the public entity while they simultaneously divest of their existing operations. Or a lot of them involve biotech companies that are publicly traded on NASDAQ, where their drug discovery just did not work out. They just did not have a viable drug that they were able to get through the process, and as a result, they're merging with, a lot of times, other biotech companies looking to go through the process. There are also more famous examples of companies that are swallowing a large private rival. For example, Wayne Huizenga, the serial entrepreneur who created Blockbuster, started buying up years after he left Blockbuster. He started buying up trash companies, and he bought and took control of assembled a large privately held trash collection services company. I forget the name of it. And then he started buying up shares of another publicly traded company, I believe Republic Services. And ultimately, as he gained influence in Republic Services, he merged his privately held business, which was about 5 to 10 times larger, into the public company.
Well, sure,
So
that makes sense, because then he had more volume and more market cap than the publicly traded company. I have not been as familiar with those. And when you and I get invited to these dog and pony shows down at the Buckhead Club, they're almost always dogs, not ponies at all. And they're trying to create a market by paying for, fancy lunches to broker dealers. And as long as they keep doing that, they get action. And as soon as they stop spending that money to do that, their stock tanks again.
yeah, we're going to get into reverse mergers, more next week, in a lot greater detail. The problem with a lot of the companies we see is their transactions are poorly structured. They get bad advice. They don't understand what it takes to create a public market, or how to put a share structure available. Or basically, when you do your merger, you've got to structure the company in a way that's going to be attractive to investors. And one of the things you really got to do is you got to look and act like you deserve money. I mean, you've got to show them how, if you put your money in my company I just took public, how are you going to make a profit? How are you going to get your money back? These are messages that that company executives need to send to potential investors. They also need to understand how to communicate with their already existing shareholders. I mean, if you're a shareholder in a company that does a reverse merger, unless it's Republic Services, the odds are that your publicly traded shares have not performed very well at all. That they're down in the dumps, to put it mildly. And so if you see a good quality company merging in and you're suddenly become a shareholder of it, then you should be somewhat excited. Or at the very least, if you've taken your company public, you should be excited to tell the existing shareholders what you've done. And if I had a nickel for every company that came in and bought us a dinner or a nice lunch, and but never communicated with its already existing shareholders, I'd be sitting on the beach someplace.
Yeah.
At least working where it's a lot warmer than Atlanta during the winter.
And the thing about, the reality is that getting a return on a public stock after it's gone public means it only happens if there's more people buying it than selling it. And so, because then the price goes up. If you got more people selling than buying, then the price goes down. And part of the problem with these companies that merge in when they're still in a upward growth stage, and they, for some reason, they've been sold that being public is going to bring, greater value to their shareholders or to being able to raise capital. We all saw what happened with ViStar, right? A company went public, started out at $1.50, went public at, I think, 12, dropped to 2, and never has been able to bring it back up again because the company that they went into had no market value. So, the roadshow aspect of creating market value is if it's not backed up with revenues that are creating the market value, it doesn't stick. Whereas that's the reason why I like Reg A Plus so much, is because the very process of raising the capital as a private company and creating the brand awareness and national advertising and all of that is necessary as part of that, you're creating the awareness, creating the momentum that carries you into a public offering versus starting flat and trying to, jump up from doing, from being a flat company, because you've got momentum and you carry that momentum into the public market.
Oh, that's definitely correct. I mean, everything has a proper place that we're going to talk about. There are situations where reverse mergers work well, and there's a lot of situations where they do not. And with the Jobs Act and the changes that allow Reg A and Reg A Plus to be viable alternatives, they are very much viable alternatives to to the traditional reverse merger space.
Okay.
But there are situations where companies, are bound and determined to do a reverse merger, and the question is, what is going to really increase the odds of their chances of success? And there's a way to really kind of stack the deck in your favor, and then there's a way to really, feel like you're salmon swimming upstream. And there's a lot of pitfalls that are really easy to avoid if you just take the time to look and see what those pitfalls are, and understand, these are things that are going to be the kiss of death if you do it. And so when we look at reverse,
let's let's talk about SPACs, right? So, like, what is a SPAC and what's involved with merging with a SPAC?
All right, real simply, SPAC is a term that stands for Special Purpose Acquisition Company. So a SPAC is a publicly traded shell corporation, has no operations, and it has gone public and raised money in the IPO process for the sole purpose of finding a privately held corporation to merge with. And unlike the go-go days of the 1980s when they were doing blind pools, where they would raise money, and hopefully by the time the merger got to occur, the money was still there, but a lot of times not. That's what these blind pools were doing. The SEC amended the rules, and among one of the big changes that has really helped SPACs and SPAC investors is that the money raised in the initial public offering of a SPAC has to be held in a trust account, an escrow account. And when the merger occurs, the SPAC investors get the option of voting no on the merger.
Really?
And redeeming their shares. So that means if you buy a SPAC on a $5 IPO or a $10 IPO, and the redemption period opens up, you can put those shares back to the company and get your money back and not participate in the merger. You can vote to redeem your shares.
Meaning the shareholders that are in the SPAC, or the shareholders, because they're buying a private company, so it wouldn't be the private company, would it?
No, it's the shareholders who bought the IPO shares. They can vote to redeem their shares.
Okay.
So the rub on this, and this is where a lot of people may not understand, you may have a SPAC that went public and raised $100 million. And over time, while it's been looking for a merger candidate, and up until the closing of that merger, you may see 80 to 90% redemptions in the current market. So as a privately held company, you may think you're merging into a SPAC with $100 million, and you may find out that at the time of doing the merger, there's only 10 million in it.
So that a merger there, or an acquisition, because that's really kind of what it is, it doesn't, the price isn't set. So you think you're getting 100 million because you're moving into this company, and you're going to be in a company that's worth 100 million, but it may be $10 million, because
you may think you're getting 100 million in cash, and you may only get 10 million in cash. And it may cost you $1 million in legal fees to get that 10 million in cash. So it's not necessarily the best alternative. I had one
riskier than a straight up acquisition then.
It can be riskier than a straight up IPO, yes.
And acquisition. Acquisition is a negotiated price. You don't get to the table and they go, "Oh, sorry, we're going to give you 10% of what we originally contracted with you to do."
Yeah, it can be riskier. I mean, there's ways they use enterprise value measures to help mitigate that risk, but in my opinion, it's definitely can be a lot riskier than a reverse merger. I had lunch down at the Atlanta Fish Market with a company that was presenting, and as I sat next to the CFO, they said they did a reverse merger with a SPAC. I won't mention the name of these companies, but he said basically the only thing they got out of the reverse merger with the SPAC was their ticker symbol, and it cost them $1 million in legal fees to do that. So it did not prove to be a great transaction for them, because they incurred some dilution for that. You know, that dilution is a negative event for their existing shareholders. But
so it seems like I can't imagine why anybody. I mean, I get why a group of people might create a SPAC because they're intending to go and almost basically, instead of being a private equity fund acquiring private companies, they're going to be a public company acquiring private companies. But there's no obligation, no commitment, no accountability to actually deliver the value of what they proposed when they first went public. That seems like it's like a total Ponzi scheme.
Well, SPACs are definitely a lot more complicated transactions than they used to be. Years ago, I knew a gentleman by the name of Fred Joseph. He was the former chairman of Drexel Burnham Lambert, the storied investment bank from the 1980s that Michael Milken worked at. And he formed a new firm called Morgan Joseph. And over time, they moved into raising capital for SPAC transactions. And what he told me, because they did a lot of very successful SPAC transactions following the rule change that allowed the modern SPAC as we know it. And he said SPACs work best for privately held companies that are pretty significant in size, but not attractive for initial public offerings. And he basically said that SPACs work best for your widget manufacturer that's not sexy enough for an IPO. And he said a good example of this would be a company privately held that makes hospital beds. You know, there's be a good company, get good valuation as a public company, no investment bankers rushing out to do an IPO on it. And he said that's really where they worked best. And he said the SPAC should be formed by a management team that has very specific industry expertise, so that the investors know that if you're backing, Bob Jones, who's a successful oil and gas executive, he's going to make an oil and gas acquisition. you know, but then SPACs entered a period of time where the redemptions by the hedge funds, were playing it for I can put my stock and keep the warrants, trade, where they kind of made SPACs fall out of favor. And SPACs became, very, very sleepy little vehicles that weren't doing much until I believe it was DraftKings went public by a merger with a SPAC. And then when that stock skyrocketed, SPACs came back in vogue. But I mean, at one point we saw Shaquille O'Neal form a SPAC, and nothing against Shaq or anything else, but SPACs work best when they have experienced management teams, not celebrity founders. And so there was a big rush into SPACs. They were a hot market, and a lot of companies merged into them that really should not. Companies that had problems. I mean, 23andMe, the genetics testing company, merged into a SPAC, and as of the last report, I think the stock's around 40 cents a share, not doing well. I was personally involved in one SPAC transaction where a company I took public on the over-the-counter market got bought out by a SPAC, had an unsolicited buyout offer, and by the time the merger was completed, it took 9 months, and they were only able to get about 5 to 10 million, I believe, out of the merger. And so it was a nice chance to go ring the opening bell, but maybe not the best of outcomes for that company at that point in time.
Okay, so what about cross-border listings? Is that like going public in Canada or England or something like that rather than the United States?
That is exactly what it sounds like. That cross-border listings, for the most part, there's two ways those occur. You're a U.S.-based company and you engage in an IPO or a reverse merger that occurs on a foreign stock exchange. For a U.S. company, that might be trading on the London AIM exchange. That's their venture exchange. Or you might merge in with a company that's already trading in Canada on the Canadian Stock Exchange or the Toronto Venture Exchange.
You have to merge into a company in Canada, or can you just go public in Canada?
You could do an IPO. You could also do an IPO in Canada. Then also what we see for a lot of cross-border listings is already existing companies in Canada, Australia, London, and some of these other qualified exchanges apply to have their shares traded here in the United States, either on the over-the-counter market, which is very common, or they trade on a national stock exchange.
So when a company is public, like full-on public in another country, and then they want to offer be traded in a U.S. exchange, is it a separate set of stocks, or are the origin country stockholders now offering their stocks on the foreign country exchange? How does that work when there's like a pool of stock of one company?
That's a really good question. A lot of times you have the shares of the domestic market also traded over here. So, for example, with a lot of Canadian companies, they have what they call ordinary shares. That's the term throughout the former British Empire. So, Canadian and Australian companies have ordinary shares that will qualify for trading here in the United States. And that's because, due to an SEC rule, there's an exemption from registering your shares or filing with the SEC and allowing the public filings of your home country to satisfy the disclosure requirements. So if you're traded on a foreign exchange, your shares can trade here in the over-the-counter market. Sometimes, for a variety of reasons, it's not practical to trade those shares, and they'll create what they call an American depository receipt. And an ADR is a synthetic security. where you might combine, multiple numbers of shares into a depository receipt for listing here in the United States. And I'll give you an example. I met with a company on Thursday last week. Their shares trade in Australia, and their shares are trading at the equivalent of 3 cents. Well, a 3-cent stock in the United States qualifies as a penny stock. But if you were to combine 500 of those ordinary shares into an ADR, you would have a $15 stock in the American Depository Receipt that's not a penny stock by U.S. legal standards. And then there are other reasons why, because London stocks or London listed securities, British securities, have a stamp duty tax on their transfers. And so if you create an ADR, you can avoid the stamp duty tax. So where it's not practical to trade British stocks directly in the United States, ADRs are very practical to trade. And so there's a variety of different reasons. And we'll look at that in another podcast. But there are a variety of different reasons why you trade an ADR versus the ordinary shares here.
Yeah, I think when we talk in a couple of weeks on and go for a deeper dive, it would be good to understand, because when normal private company has their authorized versus issued shares. So when they have to create more shares or, combine shares in such a way, what does that actually look like? Because that seems like it would be really complicated, and, the benefit of going through that just to get on a U.S. exchange, seems like what would that be? So as we get ready to wrap up, a question comes to mind. So why would a company choose to go public on NASDAQ versus the New York Stock Exchange?
Well, that's actually a pretty easy question. The exchanges are very similar. And what we're finding in today's fragmented market with the great number of exchanges we now have in existence, only about 20% of your average daily trading volume occurs on the actual exchange where your shares are listed. So that means if I am president of a company on the New York Stock Exchange, about 20% of the actual trading volume is going to be on the NYSE. And that other 80% is either going to be through matching directly at broker-dealers like Citadel Securities. It's going to occur in dark pools, these alternative trading systems, or on other exchanges. So if my shares are listed on the New York Stock Exchange, the trades can still be executed through the consolidated tape, as it's called, which allows the shares to also trade through NASDAQ member firms and on the NASDAQ exchange as well, because it's more of a matching and execution service than anything else. And that does allow for consolidated price quotes. But for the smaller companies, the exchanges differentiate themselves with slightly different listing requirements and slightly different corporate governance requirements. And a couple years ago, NASDAQ implemented a bunch of rule changes for diversity requirements, of saying requiring diversity among your board members, for example. And the NYSE Venture Exchange did not implement those same requirements. For a lot of small companies, getting qualified board members is an extreme challenge. And they just found the burden of the NASDAQ rules to be a little bit too cumbersome. And so they would shift their listings over to the NYSE Venture Exchange, also called the Amex at times. Or there are differing definitions of what constitutes public float, or for example. So there's these slight nuances in the rules that vary between these exchanges that make one exchange more attractive than another. Or, for example, your underwriter may be a member of the New York Stock Exchange, but not a member of the NASDAQ exchange. So your underwriter may just have a personal favorite.
So that's for initial public offering. But what you were talking about, the diversity requirements, there were companies that were already publicly traded on NASDAQ, for example, that then moved, those applied to publicly traded company without a window to implement or strive for. It was like, boom, you're either doing this or not, and then you get delisted if you don't do it, so you better move to a different exchange.
Well, they give you a grace period to phase it in. So the larger companies have an easier time meeting these requirements, and the smaller companies either get exempted because they're small, or they have this grace period, and they just keep saying, well, we're requesting extensions and trying to meet this, or they suddenly get Bob's wife to help out, and those sort of things happen. But um, the NASDAQ rule has been repealed. They pared it back. They found out it was detrimental to their business, which is
it was the Supreme Court said, or the Fifth Circuit Court said that they couldn't do it.
That also would do it. The court says that's a no.
2024 in a 9-8 decision.
Yeah. So, and what people don't realize is there's a lot of competition between the exchanges to win companies over from the other exchange, and there are perks they will give you for being a member of their exchange. For example, if we list a company on the NYSE American, the venture exchange, we get to use offices at the New York Stock Exchange whenever we're in town for meetings. So, for example, if one of my projects lists on that exchange and I go to New York, I can hold meetings with people at the New York Stock Exchange. They have executive suites that you're able to use while you're traveling in town. And so they throw a lot of perks out there, and these offices around the country, that's one of the things they do to compete. And it does have an impact.
Okay, well, I think we did a pretty good overview that covered a lot of ground and sort of starting it up, more information to cover. I think when we get back into going deeper dive, we might get into more of what the difference in the exchanges, talking about one we didn't talk about, Dutch auctions or other ways for companies to go public that have been tried out there rather than traditional IPOs, reverse stock splits, talk about some of that kind of stuff when we dig in a little bit deeper. And, I think next week when we get into hot topics, we can talk about the OTC ID ruling that's going to go into effect a little bit in a few months this year. Also, this kind of rise of states looking at creating their own exchanges, because it seems like that would have the same sort of cross-listing issues that you would with, a foreign country listing in the U.S. versus, why would you pick one or the other? We talked about a little bit why people pick New York Stock Exchange versus NASDAQ. And, there's difference in the marketplaces or who plays in those things, but that a lot of that differentiation has kind of become null and void because of the way, off, I guess, sort of sideline transactions are done, sidebars are done that make those things happen.
Yeah, we're going to take a good look at that. I think we're doing a deep dive next week on reverse mergers, which will be pretty interesting.
Hot topics next week.
Hot topics and how that applies. And we'll have this posted up on Spotify here shortly. Please feel free to tune in next week, and hopefully we'll see you then.